Welcome to the latest edition of our virtual investor video series. I'm Susanne Matern, Head of European Structured Finance. Today I'm joined by Markus, Head of EMEA ABS. We are going to discuss the 2023 mid-year outlook and rating performance. Welcome, Markus. So let's jump right into it. Your team recently published some comments about our asset performance outlook for the subsectors you covered, most importantly unsecured ABS and auto ABS, and you maintain both on deteriorating. What are the reasons behind that?
Generally, it's still pressure on household finances we are most concerned about. So remember last year we said, the inflationary impact is still to be felt. Well, safe to say it is being felt now. We see deteriorating measures in both delinquencies and defaults, although still very much at modest levels. The reason to maintain the deteriorating outlook is the underlying factors are still with us. So inflation seems to be getting under control a little, at least outside the UK. But the interest rates that were necessary to get there, they're still rippling through. So that effect is still coming. And again, for the UK, we of course see that interest rates may actually go higher and stay there for longer, which again will take a few months to fully impact borrowers. And also, quite frankly, the effect it will have on the economy at some point becomes a bit concerning in its own right. That said, we have been fairly cautious in our assumption setting for some time now, still are. So as far as I can tell, I'm reasonably confident that for now it's an asset story. It's not yet a rating story.
But I believe previously you differentiated between auto ABS on the one side, assuming it should remain largely unaffected, and then unsecured ABS, which we expected to be more affected. So is this differentiation now over, looking ahead 12 to 18 months?
It's not over, so the tiering still pretty much is in effect. Still, relatively speaking, for autos, we are least concerned, so it's a bit of a technical impact. It needs to increase from where it was. The utility of car ownership is still a very, very strong incentive to pay, so that continues to be the case. Also, car owners, on balance, are a bit more affluent than everyone else, which, of course, gives them a higher capacity to absorb higher costs. That has its limits, as we know. And also, the more affluent car customers may actually be the ones that could be affected by higher mortgage costs to come. But if you step back a little, this capacity to adapt, capacity to absorb costs, actually it's been fairly impressive across sectors and across the spectrum. So if we look back to what we thought about the card borrowers, we were very concerned they would just draw down on their balances and just keep spending no matter what. And that's not been the case. So the data doesn't bear that out. They actually have adjusted their payment behavior quite drastically, cut down on non-essential items, which made sure they haven't been impacted as much. And actually maintaining an open limit for cards may actually be a utility in its own right. So that leaves us with the pure unsecured loans, with no utility to speak of. We are indeed still most concerned about them. Most lenders we talk to actually are a bit surprised as we are that the impact hasn't been stronger yet. But by now we are gathering actually a bit more anecdotal evidence that, the stress is actually increasing.
Now, coming back to auto ABS, the benefit of securities or of the auto as the collateral can also have a downside, namely if we get the recovery assumptions wrong, too high. So should investors be concerned about auto recoveries?
That's a very good question, right? With the impact of the pandemic and, supply chains and new technologies coming in and regulation for old technologies, one could say we're a bit in uncharted territory, right?
Okay, but I believe we didn't change our assumptions, right?
That's right, and there are good reasons. So, with a bit of a caveat, for electric cars, for pure battery electric vehicles, we do maintain higher stresses just because the market is less well developed, not as mature, not as deep. And now the question is whether we should, apply those higher to the entire market. And I think there are very good reasons why that is not warranted. And I think the starting point matters. So the markets for combustion engine cars are so deep, very liquid, very broad, that actually any impact we will see sort of has time to be absorbed. We also know that tenor of car finance is relatively short compared to that, let's say, regulatory off-ramp that we see towards 2035. So there are good reasons to assume this will be an orderly impact. And again, there's actually a very instructive precedent that we see, and that's still diesel, right? I mean, it's a technology that spectacularly fell out of fashion a while ago, much more so than we think combustion engines ever can or ever will, at least with what we know now. And still, it was broad market, and used car prices, despite some early hiccups, have remained remarkably solid.
Right. Last year we discussed a lot about buy now, pay later, new trends in the unsecured space. But this year the conversation seems to be more on auto. Is this observation correct?
No, I think that's very much spot on. I mean, obviously BNPL will remain with us as a product, but this year it's indeed more and more about autos. I mean, electrification is still a big issue, big topic with investors. More so, interestingly, leasing. It's obviously not new per se, but there's increased push towards leasing. It's kind of a sign of OEMs trying to monetize the car over its entire lifetime, not just at the first sale. And leasing and the maintenance packages, the services that can be sold around, the control you have on the entire lifetime, that's a big push. As is, discussion around dealer agency models that we see more and more often. And one of the more exciting developments, I guess, in the auto space is really car subscriptions, right? I mean, that's coming out left, right, and center. Fair to say there's not one business model, and when they come to us, it's very likely there will not just be one rating approach or framework, but it would be very surprising same time next year that there's none in the public market.
Okay, thank you. Now let's leave auto to the side. Are there any other interesting developments beyond auto?
Yeah, I guess the other big point is solar. I mean, Fitch has been active in US solar for some time now, so established a very, very good presence. And it is something we are starting to see in Europe, and unsurprisingly, so the market is lagging the US a little, also because it's much more fragmented. But we have some interesting initial conversations on the topic, and we're actually doing right now the work on comparing, contrasting between the two regions, just to make sure that we have the right framework in place. I think we do. The tools are there, so I'd say watch this space.
Thanks for your insights, Markus, and thank you for joining us. For more information on EMEA ABS, please visit us at fitchratings.com. And if you have any questions on the topics we discussed, please send an email to the address on the screen.